I'm going to talk very briefly, if it's possible, on over-the-counter markets. Patricia's done a fabulous job talking about the exchanges, and those of you who know me know that I'm a big fan of clearinghouses, and I think I recently was quoted as saying that I have a big gripe with the exchange, in that the exchange has not said strongly enough what Patricia said several times today. There has never been a default in a U.S. regulated futures exchange that has a clearinghouse behind it. And as we look at all of the backwash from 2007, 2008, 2009, I think the exchanges are taking a lot of unnecessary criticism and focus from regulators and politicians, and they shouldn't, because the exchanges were not the problem. The problem was that people traded away from the exchanges. Now, that said, I'm here to talk about people who trade away from the exchanges. And also, those of you know me know that I do sort of like over-the-counter markets. And we do a lot of work trading for our clients and advising clients on trading. And in the PGM markets, especially rhodium, ruthenium, iridium, you trade over-the-counter because there is no exchange. But there is some confusion, and I'll come back to a little bit of it later. What is an over-the-counter market? And basically, an over-the-counter market is anything that's not traded on an organized exchange. You know, we're actually doing an iridium trade for a client right now, a client for whom we had bought iridium a couple years ago at a much lower price than it is today, and we're selling it. We call up a dealer. We say to the dealer, you know, we'd like to sell it. Today's price at Johnson Matthey is $1,065. And we conclude a transaction, and there's a wire transfer, and then we release the metal. That is an over-the-counter trade. Over-the-counter trading occurs all over the world in all sorts of products, and it's a very important part of the market, and it's very much integrated with the exchange. And I'll show you some charts. A lot of criticism in the marketplace, especially in the gold and silver market, where you have people who like to criticize things that they don't understand, has to do with, well, why do they allow banks to trade on the exchanges? I can understand having commercial entities trading on the exchange, but why are banks allowed to trade on the exchanges? Well, a bank is a commercial entity, and in fact, the vast majority of the volume that is traded by commercial entities on the exchanges are banks and other financial intermediaries. If you're a producer or a refiner or an industrial user, there's a very good chance that you don't want to get involved in the exchange, and you will do your transactions, your selling of your output, in some cases your hedging of your material during the production, or in the case of a consumer, the purchase of your raw materials. You'll be doing that on a principal-to-principal basis with a dealer or a bank or a financial intermediary, and you will be working in the over-the-counter market. That financial intermediary then turns around and hedges its exposure on the exchange. And it's critical that the exchange is there for them to do that in order for them to be able to give you a fair, reasonable price with some price assurity and everything else. So the OTC market is heavily integrated in the futures market in ways that people don't understand, and it's integrated throughout the business. It's interbank trading, it's dealer trading. It occurs in London, New York, Tokyo, around the world. And there are certain terms that we use that we misuse. So we talk about the London interbank market, and everybody thinks it's a bunch of banks in London, whereas in fact the London interbank market is a global market, banks trading everywhere around the world. And we talk about physical metal when we mean OTC metal. So you find critics who don't really say, wait a second, you know, the London bankers are grossly misidentifying their trades, because most of those trades actually are forwards or swaps or options, and they're calling it physical trades. And actually, the London market to its credit, never uses the word physical trade. If you go to the LBMA's website, they don't talk about them being physical traders. What they do talk about is you can open a bank account with us, you can open an account with one of our banks, and you can trade on a principal-to-principal basis in the forward market and in other derivative markets, and they talk about it all as an account. They never use the word physical. But yet you'll find critics of the OTC market say, well, they're really misrepresenting themselves. And the CFTC, in looking at the silver market a few years ago, I think did us all a really big discredit by using the term physical the way a lot of us do. Well, in the physical market, meaning the OTC market. And then the people were able to say, well, wait a second, that's not really physical. And so, well, it's the CFTC saying that it's physical, it's not really. But the OTC market is basically anything that's not traded on an exchange. It's totally opaque. No one really knows how much is traded there, although we can come up with various measures, and I'll show you some numbers in a second. And it's a wide range of transactions. I don't know if you can see these numbers: gold, silver, platinum, and palladium. And the top line is physical supply. This is the flow of metal into the market from refined metal. So it's mine production and scrap. And you see in physical supply of gold in 2010 was 121 million ounces of gold, 987 million ounces of silver, 7.4 million ounces of platinum, and 8.4 million ounces of palladium. Now, that doesn't mean that in the physical market, that's the only spot sales that are going on. Because if you look at any one of those metals, let's just grab an ounce of platinum. The mine, in some cases, in many cases, the mine will in fact smelt and refine the metal itself. But many other mines will actually sell its material in semi-refined form to a refiner such as Johnson Matthey. So there's a transaction. That refiner then will refine it into metal and sell it to a semi-fabricator who might make it into wires or plating salts or something else, who might sell it to a fabricator of something like a sputtering target, which is used then to make an electronic component. And that ounce of platinum will have gone through 5 transactions from the time it was mined to the time it's used. In the jewelry industry, you'll find that it can be even more times because you have more people and more intermediaries. So you have this turnover of material that is several times annual physical supply. And we've seen in the past, sometimes people get confused because they'll go up to Rhode Island and New England where a lot of the jewelry trade is, and they'll start talking to people and they'll say, well, how much gold do you use in jewelry? And they'll talk to a refiner, and then they'll talk to a semi-fabricator, and then they'll talk to a fabricator, and then they'll talk to a finings manufacturer, then they'll talk to a finished jeweler, then they'll talk to a wholesaler, and they'll come back and they'll say, wow, the U.S. jewelry industry is being grossly miscounted. You know, it looks like it's 3 million ounces, but it's really closer to 12 million ounces because they're double and triple counting the physical ounces of gold flowing through that market. So you have to be very careful about what you're measuring, but you also have to understand, when we talk about the physical supply of platinum being 7.4 million ounces, that doesn't mean that there's only 7.4 million ounces of physical spot platinum trading hands in a given year, because an ounce of platinum being used has a multiplier to it in terms of the number of transactions, and it may be closer to 30 million ounces of platinum that trades on a spot physical basis on that hand. The next line down are futures and options, and you can see, gold, 121 million ounces of new supply, 6.4 billion ounces of futures and options trading last year. In platinum, it's 7.4 versus 93, and palladium, it's 8.4 versus 97. So the futures and options market is a large multiple of the physical supply and the physical spot market. And that's as it should be, because as Patricia was saying, we bring in investors, we bring in speculators, we bring in a host of intermediaries, we bring in a lot of people who aren't necessarily producers, refiners, processors, physical consumers of the metal, and they, for a variety of reasons, often to make money, not that there's anything wrong with that, will trade the stuff. So you have, it's a natural thing, and you see this across markets. The amount of T-bonds that trade on the CME markets is probably about 100 times the amount of T-bonds that are produced by the U.S. Treasury and sold in the physical T-bond market in any given year. And you add that up and you can find, 100 million ounces of platinum trading and 105 million ounces of palladium. Now, the next part is the London Interbank Market. And the London Bullion Market Association, which is the trade association that represents London gold and silver banks, trading banks, they produce data on their clearing volumes, the amount of gold or silver that trades across their banks from bank to bank, and through the London market specifically. You can see 11 billion ounces of gold and 125 billion ounces of silver. The London Platinum and Palladium Market Association does not produce that data, so we have no idea of what's really there. And that's, it's an interesting aspect of it. It's bad for a researcher because you have incredibly opaque and underreported markets here. I don't mind it because it makes life a little bit more interesting. What's the relative size? Well, it's hard to say. Again, approximately 7.8 million ounces of physical platinum produced last year or this year. And again, there's a multiplier, so maybe it's closer to 35, 40 million ounces of physical trading in the process of production, smelting, refining, fabrication, and use. 93 million ounces there. Year to date, about 100,000 ounces have actually been delivered via the Nymex. For a full year, it could be around 125 million ounces this year. But a large portion of that is actually not taken physically out of Nymex registered depositories. Banks will take delivery of it and they'll leave it there and then they'll redeliver it in 3 months' time. So it's not an accurate measure exactly of how much physical demand is being met by the market there. And again, in palladium, about 9 million ounces of total supply. There's a multiplier there. Maybe it's 40 or 50 million ounces that trade versus 97 million ounces in the market. Year to date, we've had about 287,000 ounces of palladium taking delivery. There are some people who are actually using the palladium market, the Nymex palladium market, and you'll see a steady delivery, and you have seen for several years, of a steady delivery of palladium. That is, the owners hedge their position with the Nymex. The material is physically at a Nymex registered vault, and every month or so they will sell a few thousand ounces, and the metal comes out. So you are seeing a little bit more of the Nymex serving the physical market in palladium than you are in platinum. Now, a few key issues. Again, the physical turnover, as I said, there is this multiplier that one has to take into effect. Fortunately, there's just no firm numbers here. There is this interaction between exchanges and OTC markets. There's pricing, price discovery, and arbitrage. It occurs very clearly here in New York on the exchange on an ongoing basis. In the OTC market, the pricing is much more fuzzy. In London, they set a fix twice a day. There is a price that trades, platinum and palladium change, the prices change continually around the world, but twice a day there is a fixed set price in London, which is often used in contracts between, say, a producer and a consumer, or a producer and a refiner, or a refiner and a consumer, so that there will be a car company that'll say, I will buy basis the Nymex average price, or I'll buy basis the average London fix, or I'll buy basis the Johnson Matthey or BASF or other published price. There are hedging facilities and capacities that exist primarily here, but they also exist in the OTC market. And it is those merchants that often are the people who are doing it. And then I've already talked about what is physical. A few charts here, and this is the non-commercial open interest in platinum. And it's just not necessarily where I want to focus, but these are groups, these are primarily investment funds. Some of them are CTAs, commodity trade advisors, commodity pool operators, hedge funds, all sorts of institutional investors, a few high net worth individuals, non-commercial entities that have a large position on the Nymex. And you can see right now the open interest has been around, well, it's been over 1 million ounces at any given time, and it's been as high as 1.4, 1.6 million ounces. These are people who don't get involved in producing or using platinum as a commercial enterprise, but they're interested in it as an investor, and they come to the Nymex to buy that exposure. They are able to buy that exposure because the commercials come to the Nymex to hedge their physical transactions. So in every ounce sold, every ounce bought long is offset by an ounce that's been sold long, short, and the people who are selling those ounces short primarily are commercial entities. And again, those are primarily financial intermediaries, but in some cases it is, in fact, especially in platinum and palladium, as opposed to, say, gold and silver, you will have companies that, like refiners and semi-fabricators, much more active here. And it's because they are able to come to the Nymex to hedge their OTC positions that they're willing to sell short here, because they're trying to make money by doing business. If you're a bank, you're going to make more, you're going to make 25 bips, 50 basis points on a trade if you're really lucky, or have a naive trading counterpart. And they try to make money by doing their business, and what they want to do is get price protection, or protection from vacillations in the price, and so they'll go short here. And you can see that this is a reflection or a shadow of their OTC market. So if you see commercials being long 1.9 million ounces of platinum on the Nymex, that reflects the fact that they're probably short 1.9. They're probably long 1.9 in the physical or OTC market. Same sort of situation in palladium. You have 1.2, 1.4, 1.6, 1.8 million ounces of investor open interest on the long side, net long, and it's offset, it's met by dealers and banks and merchants and fabricators willing to take those short sides. Now, I mentioned price discovery, as did Patricia, and I'll tell a little bit. The Nymex has the platinum price and a palladium price. TOCOM does, the Shanghai Exchange has those prices. There are the London fixing prices. Johnson Matthey and BASF have daily prices, or several times a day prices, actually, because they have Europe, United States, and North America and Asia prices. There are other companies that also have similar prices. Metals Week quotes a price, and some of the banks will quote prices. And all of those prices are interrelated through arbitrage. It keeps everybody honest. There's only so much that you can get out of whack before you start losing business because you're not in line. I'm going to skip over this table because it's probably too short, but what we did is we looked at platinum prices on the exchanges and in various OTC markets, the London Fixed, BASF, JM, and JP Morgan. And we looked at 2 days, we looked at it year to date, and you can see that they're relatively close. The London Fixed tends to be, we use Nymex since we're here, as the denominator here. And we said, well, what's the differential from Nymex? And maybe I should be saying CME, I don't know. But it's always the Nymex to me. And you can see that the London Fix was the most distant, and that may actually reflect the time of day and also changes in trading patterns that occurred during the time of day. So the Nymex price, the London price is fixed at a time later or more distant from the Nymex. These are Nymex settlement prices. So the distance in time between the London Fix and the Nymex settlement may be greater than what you see with the BASF and JM and JP Morgan prices, which are all, I think, noontime prices and closer to it. But you can see graphically, they're all relatively close. The London Fix is the most distant, and it's about a $3 discount on average so far this year. And they're all relatively close to the Nymex, and the arbitrage insists that. And a similar situation with palladium, although strangely enough, BASF is a little bit more high priced than everybody else, which is something interesting. I'm sure that CPM Group will be producing a report trying to explain that at some point. But that, in a nutshell, is the OTC market. We bring it up because the OTC market is extremely important to the physical PGM markets, as it is to all commodity markets. And the OTC market is under a lot of pressure right now from politicians and regulators who say things that make us concerned that they don't necessarily quite understand what it is that they're trying to regulate and legislate. On that happy note, I will turn the podium over to George Gero, who will be much more elucidating than me. Thank you. Oh, I guess, any questions? Are there any questions for me? Good.
Thank you.